Imagine this. You buy a stock. A few months later, money quietly appears in your brokerage account. Not from selling it, not from some crypto moonshot, but from the company itself, just for holding the stock. That payment, that's a dividend. Now multiply that quiet trickle of income across 50 different companies, and you've just built yourself a personal cash flow machine. The only catch? You need to know how it works, because not all dividends are created equal. And some, as you'll see later in this video, are little more than shiny bait masking financial rot underneath. But to understand how to spot the good from the dangerous, we need to start with the most basic calculation investors overlook. At the heart of every dividend strategy is one number: dividends per share. This is the total amount a company pays out in dividends, divided by the number of shares outstanding. Let's say a company pays $1 billion in dividends and has 500 million shares. That's $2 per share. Simple enough. But here's where it gets interesting. A growing DPS over several years isn't just a sign of more cash. It's a signal that the business is confident. It suggests management sees enough stability in the company's future earnings to commit to returning more cash to shareholders. But that raises a question. What if the stock price is changing dramatically? That's where the next metric steps in. Dividend yield. Dividend yield tells you how much income you're earning for every dollar you invest in the stock. It's calculated by dividing the annual DPS by the current share price. So if a stock trading at $100 pays a $3 annual dividend, the yield is 3%. Sounds good, right? Not always. High yields can be a warning sign. If a company's price has dropped fast, maybe because investors fear declining profits, its yield will spike. But that doesn't mean the dividend is safe. We'll show you how to spot that kind of trap later in the video. But before that, let's look at the one thing that separates short-term cash from long-term growth. Imagine two companies. Both pay a $1 dividend today, but one has kept it flat for 5 years. The other has grown at 8% per year, like clockwork. Over time, the difference becomes massive. The dividend growth rate, usually measured as a compound annual growth rate, or CAGR, shows how reliably a company is increasing what it pays out. And companies with long track records of dividend growth, like Johnson & Johnson or Procter & Gamble, tend to also have strong earnings, loyal customers, and disciplined management. But here's the twist. Growth doesn't matter if it's not sustainable. And to judge that, we have to go one level deeper. Dividend payout ratio. The dividend payout ratio tells us how much of the company's net income is being returned to shareholders. Let's say the company earns $5 per share and pays out $2. That's a 40% payout ratio. This is where the math meets the strategy. A low ratio, say under 60%, means the company has room to grow the dividend, reinvest in the business, or pay down debt. But if that ratio climbs above 100%, it means the company is paying out more than it earns. That's not sustainable. Still, earnings are an accounting figure, and dividends are paid in real dollars. So to really understand how safe a dividend is, we need to shift our focus from income to cash. Free cash flow payout ratio. Free cash flow is what's left after a company pays for operations and capital expenditures. That's the money they can actually use to pay dividends. So here's the formula. Total dividends paid divided by free cash flow. A ratio under 75% is generally considered healthy. Over 100%, that's a flashing red light. This is one of the first things institutional analysts look at, because cash, not earnings, pays the bills. And if a company is burning through cash to fund dividends, it might be masking deeper problems. But sometimes even good cash flow isn't enough, which brings us to the final piece of the puzzle: balance sheet strength and management discipline. Dividends are not guaranteed. If a recession hits or credit tightens, only companies with strong balance sheets can keep paying. Look for low debt-to-equity ratios, high current ratios, strong interest coverage. These metrics show whether a business can survive a downturn without slashing its dividend. But it's not just about numbers. Leadership matters. Has management consistently raised dividends through multiple market cycles? Did they hold steady during the 2008 crisis? What did they do in 2020? These are not just numbers, they're signals. Signals that show whether the people running the company treat the dividend as a gimmick or a promise. Because in the end, the best dividend strategies aren't built on guesswork. They're built on discipline. And speaking of discipline, there's one more thing you need to know. Most people think dividend investing is about finding the highest yield. It's not. It's about finding reliable, growing income streams backed by strong businesses with smart leadership. So here's how you spot them. Use DPS to see what's being paid. Use yield to measure income versus price. Use growth rate to track consistency. Use payout ratios to assess sustainability. And use cash flow and balance sheet data to know whether that dividend is built to last. That's how smart investors don't just chase income, they build wealth.